One of the benefits of free markets, open public markets, and publicly traded companies is that many investors worldwide from all different walks and places, from professionals to individual investors, make their decisions about what companies to invest in and have the independence to do that. Um, so, this diversity of opinion that happens with so many parties voting with their money on which investments are likely to do well and which aren't, um, combines to accomplish price discovery. So, is the market price, the prices that you see on your computer that a company's trading at, is that the fair value? I would say at that moment in time that it is, because it's the consensus of many buyers and many sellers in an essentially an auction environment. So now that value may change, the opinion of that diverse group may change, but at that point in time, I would say that the market price is the fair value. Um, so some argue that the marketplace does not do a good job allocating capital to the best uses. For instance, things that would help social society the most. So the problem is, what are the alternatives? And the primary alternative is a government making decisions about where capital is to be deployed. And of course, the U.S. government and others across the world do spend a lot of money or make up a large sector of the spending in an economy. And I believe the fact that capitalist um, countries, democratic countries, have outperformed economically fairly consistently versus socialist and communist countries. Many of us believe that that shows that government bureaucrats do not do a good job making a decision about how to allocate capital. Because if technocrats were better at that, at allocating capital, investing money in an economy, then those economies should outperform. But they do not. Instead, they underperform. And in fact, if you take international business, you will learn that large global companies look to invest in countries that are more democratic and less totalitarian because the people make better decisions at how to allocate capital than government officials. At least the performance of economies have indicated that. So I alluded to this in the last video on this chapter, this little graphic at the bottom of this slide. Um, it displays, let's say we've got consumption over here, this straight line, right? And so throughout your lifetime, your age, as you age through life, we're assuming that your consumption stays steady. But as you earn more going up this curve right here throughout your career, you have the opportunity to save more if you manage your consumption. If you keep your consumption at this flat level, you'll have excess funds right here that you can invest. And then as you age and begin to earn less at this point than you're consuming, your savings will then support your lifestyle. So that is a real advantage to the financial markets. You can invest your money and it can earn a return so that you can use it later. Another good thing about the financial markets is that it provides us the opportunity to invest at the level of risk, accept the level of risk for the return we hope for, by choosing various securities. So if we're very risk averse, we might invest in bonds. If we're more aggressive, we might invest in stocks. So fluid financial markets allow us a whole menu of risk levels with associated returns to choose from. Is there always an expected risk return trade-off? I would say that there is, with exceptions. So why would we choose more risk for the same level return? We look for the minimum risk for a particular level of return. So all the trading activity on the markets bring risk and return into alignment. However, it's become fashionable in the past decade or so for some to invest in companies that have particular missions, like being green or some other social cause. So in that case, a particular investor might invest for some reasons other than expected return. So that's kind of the exception to the rule. This slide is about the agency problem or agency conflict. And that is, you'll recall from your earlier business training, is the fact that managers, of course, put themselves before the owners of the company. So sometimes they'll make decisions. Managers might make decisions to benefit themselves rather than the company and the shareholders / owners, right? So that's an issue that has to be managed. And some of the ways that the agency conflict is managed is with stock options or performance-based compensation. So that if the company does well, earnings improve, managers get bigger bonuses, and that aligns the goals of shareholders with the managers, because if share price goes up, then the wealth of the shareholders is increased, and so everybody wins. Of course, there's oversight from the board of directors, and that also helps to mitigate that agency conflict. I have a few slides here on corporate ethics. I'm not going to go deeply into this because you've seen it in other classes. But the bottom line is that without trust, companies cannot thrive. Investors will not invest in their securities if they can't trust the financial reporting from the company. And there's been a series of failures in that regard. Here's a list of some of them on this slide. I encourage you to read about Enron and Arthur Andersen, and really, stuff of movies there. Misleading research reports. You see that from Citicorp and Merrill Lynch. So obviously there needs to be accountability. Otherwise, it's just a con game if we allow managers to create financial reports that are inaccurate, sometimes purposely. So a result of that type of a history was the Sarbanes-Oxley Act, or it's called Sarbox. And some of the things that are important here that resulted from Sarbox created that act, is that the CFO has to personally verify the statements and is personally responsible, has personal accountability, is not protected by the corporate veil. So and it has also raised the bar for accountants, CPAs, of accountability. So I believe, have seen better ethics as a result of Sarbox. However, the cost of complying with Sarbox has become so high that many companies have gone private, have left the public exchanges. And in fact, there are fewer companies on the New York Stock Exchange today than there were before Sarbox. So there's trade-offs, right? If we make the cost of complying with an act like this so high, then it eliminates some investment choices for investors. We're going to talk now for a minute about asset allocation. The sequel to this class is portfolio and security analysis, and we go more deeply into asset allocation. So what is this? This is how much of your portfolio do you allocate to stocks versus bonds versus treasury bills and other asset classes. You may allocate some to derivatives, like we mentioned earlier. So So this is just kind of a starting point for investment for some methods. So if we are a top-down investment approach that we're going to use, then we would start with asset allocation. If we're bottom up, then we would start by picking particular companies. So the classic allocation is 60-40, 60 in equities and 40% bonds. And here's a couple other asset allocation examples. So a second, if we're top down, a second part of our investment process then would be picking the securities. When we talk about how much the stock market has averaged, you always be aware of what that look back period is. Are we talking about since 2000? Are we talking about the last 40 years or 100 years? This slide says that the market has averaged about 12% annual return. I'm not sure what look back period they're considering there. But the point of this slide is that stocks have averaged about 12%. And if you look down here at the bottom, you'll see that bonds have averaged under 6%, lower average returns. So we'll also learn soon that volatility is lower for bonds. Bonds are considered safer because bondholders are made whole before shareholders in the event of a bankruptcy, so they have lower risk there. So how do we measure risk? Well, one way is we look at the volatility, how erratic a stock moves up and down. We measure that with statistics with something called standard deviation. You may have learned about that in an earlier class. However, when we build a portfolio, we diversify and look for negative correlations among our assets, which will hopefully our portfolio risk should be less than the risk of all of the assets combined, because some risk in one security would offset the risk in another. You may also be familiar with the efficient market hypothesis and your belief in how efficient the markets are, how fairly priced securities are will impact your investment style and how you invest. If you believe that the markets are highly efficient, then you may opt for a passive management style. And that means you don't look for undervalued securities, you don't look for value stocks, you don't try to guess when the market is high or low. You would invest in something like an index fund like the S&P 500. There are securities that represent the S&P 500. One of them is symbol SPY. And just kind of lock your seatbelt and hang on for the ride and not worry about whether the market gets overpriced or underpriced. If you believe less in the efficient market hypothesis, then you would opt for a more active management style. You would look for, you think marijuana is going to catch on fire, so you'd buy marijuana stocks, that sort of thing. You think that oil is low, so I'm going to sell oil companies. So you're trying to kind of beat the market with that approach. You may seek undervalued stocks, value stocks there. You may time the market. You think the market's gotten very high, you'd sell. If you think it's low, you would buy. So this is just how your belief in how efficient the markets are drive your choices and your approach to managing your portfolio. This slide presents the players in the financial markets. So we've got companies that issue stock and bonds, households, governments, financial intermediaries also would include mutual funds, and not on the list here, but they would. Pension funds. CalPERS is the California Pension Fund, largest investor in the country. The Florida State Retirement Fund is also one of the largest in the country, and that is state workers' pensions or 401ks that the state invests. It goes in the financial markets. So just kind of a broad list of the players in the financial markets. So, of course, the investors supply capital. They invest in the markets. Firms are the recipients of that capital, whether it's stock or bond financing, and that's how they grow their companies. And then we've got looking at investment bankers. You'll remember that investment bankers help companies go public in the primary market. That's how new companies become public, is typically with the services of an investment. You'll also remember that those newly issued securities occur in the primary market. The secondary market is the second time a security is sold. When a company issues a new security via an investment banker, that first time it's sold is in the primary market. But if it's sold a second time, it's said to occur in the secondary market. So then we've got a series of slides that kind of go through the history of investment bankers and their ability to do what's called proprietary trading. And that means that the bank is trading, buying and selling stocks for the benefit of the bank. And over the history, law has prevented investment bankers from having a proprietary trading desk at certain points in history. Proprietary trading introduces more risk to the bank and can risk customers' deposits. So the government has put limits on that throughout history. So we're going to skip through the balance sheet information here about banks and non-financial businesses and look at the difference between a venture capital firm and private equity. So venture capitalists provide capital for new companies that are hoping to go public. Small companies, typically, it may be a team of 1 or 3 or 5, or it could be 1,000, but the point of venture capitalists typically have the goal of taking a company public and selling shares on the public exchanges in the financial markets. Private equity is typically wealthy investors or investment companies that invest in privately held companies. So you need to know the difference between public and private. All the privately held company means is that the shares of that company are not traded on the exchanges. It is private. It's a small company that isn't traded publicly. So private equity is investment in those type of companies. So we're 18 minutes into this video. I don't like for them to go over 20, so we're going to cut this off here and pick this chapter up in the next video. So until then, I want you to remember that your path to prosperity is to save money, spend less than you earn, invest it wisely, and then maybe you can retire early. So see you next time.